Today we're going to look at my companies that I'm investing in, and one of them is CISCO Systems. So what I really like about them is that they tend to be a stable company. They pay me 3.2% in dividends annually, and they are a blend of product and tech companies. So I know that currently, a lot of tech companies are having and experiencing large drops in the performance. And if you look at Cisco, they were not an exception to the overall trend. And as you can see, they've dropped almost 50% in the price that they had at the end of 2021. But overall, I like that this company is priced moderately, I would say, at this moment, but it has really bright future. And let me explain to you why. So first of all, they have really great market capitalization of 195 billion, which makes them pretty stable and large company. At the same time, they're doing 52 billion in sales with 11 billion in income, and you can see the profit margin is 23%, which is quite high considering that they are a product and a service company at the same time. They are paying 3% dividends, which is also pretty great because I don't like investing in the company that don't pay the dividend, which means that they might not earn enough money, or their business model might need this revenue in order to exist further on. And overall, I want to get dividends from a company that earns money, because otherwise it looks strange to me. But again, everybody has its own choice and its own idea in mind. So currently P/E is 17, which is, I would say, 50% less than some of the companies like Coca-Cola that have like 29, or Pepsi that have 24, 25. This is why I don't like investing into the companies that have high P/E, price to earnings. And as you can see, their forward P/E is 12, which means that the company can actually have 33% growth in the future. So from the price that we have now, it's estimated that the company might make 33% increase in just the price of share, which I really like. And it also means that the company will be underpriced, if they will have 12 P/E, because I think that a lot of funds will start investing in them right away. So profit margin is great. The forward P/E is great. The current P/E seems fine, and the dividends look pretty good. And overall, let's take a look at the business that this company is having. So overall, they do have the products, which I really like, because whatever happens to the services, products are always an anchor to ensure that people will be using your services. Even if they would like to change the vendor or the service vendor, they will still use your products. And they are providing switches, routers, wireless solution for the internet. They provide services to a lot of enterprise companies. They are making this setup for the whole IT infrastructure of large IT companies. So I think as long as this sector will exist, as long as some large companies like Meta, Facebook, Twitter, while they will be using their services, and people will be visiting offices, they will always make money on that, not only on the setup but also on maintenance, update of the products that are used in the company, and so on. And as technology evolves, now we have 5G, then we will have wireless or satellite internet. They will be always helping with all of that to maintain the infrastructure. They have wireless and mobility solutions, security systems, some IP conferencing, as far as I understand. But again, this is related to offices and what are they using in the offices. Data centers, some software and cloud solutions that you can also find here. But what we should really care about is that they produce the products, which then they use to provide the services. So it's like a closed cycle of servicing their customers, which I really like, because they can sell both products at the same time and charge the client twice. And the third time they charge client when they provide the maintenance. This is why I really like the idea of this company. And I don't think this is a tech company or purely tech company like Facebook, for example, because Facebook is not producing the cell phones, right? But if you would imagine that Facebook produces cell phones, then they could be more stable in terms of the revenue that overall the company is making. And let's take a look at the other financials of the company, like the quantity of shares. So as you can see, the quantity of shares was decreased since 2010 from 5.8 billion to almost 4 billion in 2022, which means that the quantity of shares decreased by 50%. So just imagine the quantity of shares decreased by 50%, but the price of the stock is actually a bit higher than that. But the revenue has increased also steadily over this period. So I think that this company is at this moment underpriced because their fair P/E should be around 20, if not more, closer to like Coca-Cola or Pepsi, to my view. But again, I really like that they're doing the buybacks. That the only conclusion we have to make from this, that they are buying their shares back, which means that even if the company is stable in revenue, by decreasing quantity of shares, they can provide more dividends to their shareholders and higher price for their stock in general. And again, think of it from a managerial perspective. If there is a great management, they drive great decisions, and investors, as always, benefit from this. If we look at debt to equity ratio, you can see that long-term debt is currently at 0.19, which is pretty low. If you remember my video about Citigroup, you know that they have 1.2, Wells Fargo or JP Morgan have 0.6 or 1. So 0.19 is the lowest benchmark that you can find. And if we take a look at the debt to equity sector, you can see that right here we have around, I would say 60% of the industry is in this range. And the companies that are in this range might really have the problems or experience some problems. But CISCO is in the group of 60, where 60% of the industry is, or the sector basically, which means that they're in a pretty good spot. But considering their historical debt to equity ratio, I don't see any reasons why that should not continue to improve in the future. And let's take a look at the investor relations, at their latest report that they have for Q3. Again, we are waiting for Q4 results, but so far what we can see is that GAAP results, as always, tend to decline. So in the previous quarter, but now they're also declining, but non-GAAP results are actually increasing. And I really like non-GAAP results because they're showing a bit better understanding for us as an investors, like where the things are heading towards, because this bureaucracy might not always describe what is happening to the business. And sometimes you have to use costs in this way or in that way, but overall non-GAAP results are showing an increase year over year and quarter over quarter if you look at the last two reports they had. Also, the company operates in three segments or three markets. One of them is Americas, EMEA, and APAC. So EMEA is steadily growing quarter over quarter for the last two reports that I've seen the company has. It grew like 25% in the previous quarter and 11% this quarter. So I think that's a really great perspective for the company. And especially once the euro will become more expensive towards the dollar, that eventually is going to happen, to my view. These results will even contribute more to the company than they are now. Americas was down 5%, now it's back 5%, so we can think that it's pretty flatlined over the last half of the year. And APAC was flat, and if I'm not mistaken, it was increasing last quarter. So everything looks pretty awesome. They have really diversified presence across the globe, and of course, they can grow into other markets, which gives us a perspective of this company as one of the really great service providers and product providers that is internationally that is expanding internationally. Overall, gross margins are pretty high, around 60%, which again, we can refer to this report where gross margin is 62%. So the company is charging quite nicely their clients. And if you think of it from this perspective, what might you think of their products if they can charge 60% gross margin on those or the services? So it means that either there is no competition or they are the best ones, that you would always select iPhone versus, any of the Chinese brands. So something like this is happening with Cisco when you use their solutions and the reasoning that you actually have for using their solutions. Again, you can take a closer look in here, but overall the revenue is pretty stable. The revenue is pretty flat year over year. There is no fluctuations that we should be concerned with. Let's take a look at the estimates that Wall Street Journal provides. So last 4 quarters, we can see that the actual results actually exceeded the analysts' range or were pretty close to the high estimation that they were having. So overall, the current price is at $47 and the low estimate is 44. So again, less than 10%. Lowest estimate that this company might be having, very stable, low volatile one. The average is $53, which is almost 20% to what we have now. The median is at 52 and the high is at 61. So again, the perspective that this company can grow is like almost 50% estimate. And again, let's take a look at the last 4 quarters and think, how do we think this is going to perform in the future? So I think it should be closer to like $50, to be honest, but still, considering the current results, it looks pretty great since the recession is coming and this company is not going to have any losses, at least from what we see in the reports. The analyst ratings, as you can see, changed a bit, where one analyst changed his or her estimate from 15 being on hold to 14, but the buy rating was increased by 1. So this is why we can also think that this company is not overweighted at the moment, to my view. Again, $17 I think might be, but if the company performs buybacks and has a great results in the future, that all will be normalized. And again, 3% dividend yield. Think of any company you own now that doesn't pay any dividends, and if their PE ratio is high enough, you might be less concerned with the growth of the companies will be having versus the dividends that this company can provide to you as a shareholder during the recession. Because after the recession, I'm sure these companies will have a tremendous growth that will also be powered by the other companies growing. So this is my understanding of the company. And sometimes, people are referencing to these estimations not being very accurate that we have on Wall Street Journal, that it always shows that the company will grow, And let's take just a look at the Tesla stock. So let's just compare it with the other companies. So if we look at the Tesla stock, you can see that it's also very close to the estimates, right? Or exceeding the estimates that analysts are having. But look at this information. So the current price is $123. So the low estimate is 85. So just imagine the difference between the current price and the lowest estimates is almost like $40. So it's even like $50 if I'm not mistaken. Yeah, $40. So it's possible that your current price might drop by 40% or 35%, something like this. While the average is 260, or it means that the price will double. So you basically have a pretty high chance of losing money, which is already incorporated into the analyst ratings. And there are quite a few analysts that are saying that. Again, we all know that EVs might explode, and the companies will grow massively, and Tesla doesn't have much of the competitors and so on. But just think of this risk, right? Because as an investor, you might have $85 next year. You might have $100 next year. You might have, Elon Musk having troubles and selling Twitter, and he will sell again shares because he owes like 10% of the shares that company is having. So he can earn another 3.6 billion. So this is all risk. And while I provide my estimates on Citigroup or on CISCO, I always weigh in all the factors that I consider personally when making an investment, because I'm not ready to pay for this difference. If you are, go ahead. There is a really nice, growth opportunity for the company. But again, up to you what type of investor you are. Again, these all are the recommendations from the worst investor. And this is why, consider it or not, this is not a recommendation. So I wish you the growth of your stock and less risk and more profits. Of course. Have a nice day, everybody.